Okay, in our last example in balancing, we had 2 months, January and February, where the price did not change. The price stayed $50 in January to $50 in February. In reality, we know that's not going to happen very often, right? The prices are going to change. So what do we do when there are price changes? Well, first of all, you always need to look at your contracts. Your contracts can say different things. Contracts can say you could ignore price differences. But I'd say the norm is that each company is going to realize the price that was in effect when they were entitled to those reserves. Not when they actually took them, but then when they were entitled to them. So I should be able to realize the sales price that was in effect when I was entitled to get those reserves. So in other words, if you took some of my reserves last month I underlifted, you overlifted, you took some of my reserves, you sold them for $50 a barrel. You give them back to me this month, I get them back. I overlift this month, so I get them back from you. But now I can only get $48 a barrel. Well, you are going to pay me $2 a barrel because I was entitled to those reserves when the price was $50 a barrel. You got them when the price was $50 a barrel. Now I get them back, but I can only get $48 a barrel. I need to realize the price that was in effect when I was entitled to them, which was last month. That price was $50 a barrel, so you're going to pay me $2 a barrel. That's basically the way most contracts work. Now, there are certainly contracts that say ignore price differences. And I always get a question of, well, if you're ignoring price differences, why wouldn't companies kind of play where they think the prices are going to go? I mean, you've got to read your contracts, but there are some things that are going to keep that from happening too much. So, for instance, if prices are down, we all think prices are going to be higher a year from now, then none of us are going to want to take production, right? We're all going to say, hey, we're going to wait. But, we need to be producing. So, parties are going to be forced to take some production. And if you remember, the operator has a lot to do with that. Again, the guidelines would be in the contract, but the operator will not let one party get too out of balance. So I just can't keep underlifting and underlifting and underlifting, or overlifting and overlifting and overlifting. We're not going to let those overlifts and underlifts get real significant. We're going to try to kind of keep them. We're never going to get to a zero balance, but we're going to kind of keep them to where they're not real material. So now, how do we do the accounting? How does that affect our accounts when the price changes? So assume the same facts as we just had in the other example, except in the other example, the price was $50 in January and $50 again in February. Now we're going to say the price is $50 in January, but the price changes to $52 in February. Everything else is the same. The volumes are the same. The price just changes to $52 in February. So our volumes are still the same. I did not change the volumes. Golden is overlifted in January by 123,600 barrels. They make up for some of that underlift in February because some of that overlift. They make up for some of the overlift in January by underlifting in February by 98,040 barrels, but they still have a net overlift of 25,560 barrels. And the opposite for state. They underlift in January, they make up for some of that by overlifting in February, but they still have a net underlift. So now how do we handle that? Now remember, we may look at what the accounts what's going to happen to the accounts on the income statement and balance sheet. But when we're dealing with these balancing issues, we've always got have a lot of records on the side, right? Maybe Excel sheets on the side, because now we have to know who underlifted and overlifted what month, what were the volumes, what were they entitled to in those months, and what were the prices, because now we have to not just make up volume differences, but price differences. It's almost like two sets of balancing. You've got a price balancing going on and a volume balancing going on. And again, most companies will say, we don't actually exchange cash every month for those price differences because they move up and down. You may owe me this month, I may owe you this month, but they'll say, you know, if we do get to a point where there are some significant amounts owed between the parties, then we'll do a cash balancing of the price differences and start over at zero. But normally we're only going to do that when it gets to be significant because, again, you owe me, I may owe you another month. Okay, so let's look at what happens in the actual accounts. So this is using the sales method. We'll use the sales method first. Again, under the sales method, we really have to make sure we've got good reports on the side. Okay, the video is not wanting to pick up, so I'm going to try to wear it and see if that helps at all. But if we look at the sales method, again, we're just going to record whatever we took as a sale. Doesn't matter if that's the amount we were entitled to take or not. Whatever we took is going to be recorded as a sale. So in January, remember before January, there's no imbalance because January is our first month of production. So in January, the entries are exactly the same as they were before. In January, doesn't matter what Golden was entitled to take. Golden took 300,000 barrels, sold them to a purchaser when the price was 50. They have an account receivable asset increased on their balance sheet from that purchaser for $15 million. And then they're going to have oil revenue on their income statement for $15 million. Doesn't matter what they were entitled to take. In January, State took 60,000 barrels at 50. They have an asset on their balance sheet, a receivable from their purchaser of $3 million, and revenue on their income statement of $3 million. Okay, now again, on the sales method, I've got to have all these side records that show who was under, who was over by, so, you know, how much. Got to keep that information. Now in February, this is where we have the price difference that's going to be made up for, right? So if we look at Golden, they overlifted in January. They're underlifting in February by less than the amount they overlifted in January, but they're making up for some of January's overlift in February. So Golden actually took 96,000 barrels in February. They sold that to an outsider when the price is now 52. So that outsider is going to pay them $4,992,000. That's accounts receivable from that purchaser. That asset is going to increase on their balance sheet. However, they also have an accounts receivable from State. That's the price difference between January and February. The price was 50, it's now 52. So there's a $2 price difference. They have a receivable from State, 196,040. That's the 98,040 barrels that's being made up this month at $2 a barrel, 196,040. And their revenue is now going to be $5,188,040. So their revenue is not the amount they're getting from the outsider for this year's sale, because their revenue is going to be affected by that adjustment for the price difference. So the price difference adjustment is going to affect the current month's revenue. It's either going to increase it or decrease it. In this case, it's increasing it because we're owed $2 a barrel from State. We're receivable from State. That means we're going to get, right, more revenue. So that's going to increase our net revenue on the income statement to $5,188,040. State, on the other hand, this month in February, takes 300,000 barrels, sells that to an outsider at the current price of 52. That outsider is going to pay them $15,600,000. Okay. That's 300,000 barrels at 52 a barrel. They have an account payable to Golden. They have an account payable because, again, of the price difference between last month and this month. That price difference of $2 has to be paid to Golden. So they have an account payable, which is a liability that's going to be increased on their balance sheet. So that is 196,040. So their oil revenue is actually less than what they're selling this month's actual delivery they're making to their purchaser. Their actual revenue is actually less than that, $15,403,960. Because I have a liability for that price difference, I have to pay for that price difference, that's going to decrease this month's net revenue to $15,403,960. Okay. Now, that's sales method. We've got to have a lot of entries on the side. A lot of entries on the side. You know, not really formal accounting entries, but a lot of entries on an Excel sheet, let's say. So we're always knowing who's under, who's over, by what amount. What amount was that underlift or overlift created at? Remember, that underlift and overlift for those parties is still there from the month of January. So it was still created. We still have a net overlift for Golden, a net underlift for State. Those amounts were still created at $50. They were still created the first month. So if we make up for those amounts in March, let's say, we'll make up the difference between when they were created in January at 50 and whatever the price is in March. So if the price is 54 in March, there'll be a $54 price difference. Now, if we look at entitlement method, again, we have a little more information here. The entries for January, just like with the sales method, did not change. Entries for January did not change from our previous example. In January, Golden took 300,000 barrels, sold those barrels to an outsider at the January price of $50 a barrel. So they have an account receivable from that outsider on their balance sheet for $15 million. If I skip down to their revenue, though, their revenue is based on what they were entitled to take, not what they actually took. They were entitled to take 176,400 barrels. At $50 a barrel, that's their revenue on their income statement. As we said in the last example, the revenue in the income statement is $8,820,000. The difference between what they took and what they were supposed to take was their net overlift. Remember the balance report, they overlifted by 123,600 barrels. So their overlift at $50 a barrel, their over-under account, since they overlifted, we're going to say that account is decreased, or it's a negative on the balance sheet of $6,180,000. And just like before, State has the kind of opposite thing going on. First of all, if I look at the second line, State took 60,000 barrels, sold them to an outsider at 50. That's a receivable from that outside purchaser of $3 million on their January statements. Their revenue, based on the balance report, they should have taken 183,600 barrels at the current price of 50. That's their revenue, $9,180,000. The difference is, opposite from Golden, they actually took a lot less than they were entitled to take. They took 123,600 barrels less than they were entitled to take. At 50, their over-under account is increased because they're owed. They are owed reserves or future production, let's say. So they underlifted by 123,600 barrels at 50. That's an increase on their balance sheet in the over-under account, or in other words, they have a positive or a receivable because they underlifted 6,180,000. Now, if we look at the next slide for February, now the price difference comes into play. Again, let's look at Golden. Golden took 96,000 barrels in February at $52 a barrel. That's a receivable from an outsider because they sold those to an outsider at the current price of $52. So they have that receivable for $4,992,000. Now, let's skip down to the last line first. Their revenue is based on what they were entitled to take this month, which per our balance report was $194,040 at 52. So that's going to be his revenue on their income statement, which is $10,090,080. So if I go back to their over-under account, for this month alone, they took 96,000 barrels. They were entitled to 194,040 barrels. So for this month alone, they underlifted by 98,040 barrels. An underlift, we're going to say, is going to increase that over-under account. Now, last month we overlifted by more than this, by 123,600 barrels. So what we're doing is we're making up for part of last month's overlift, but not all of it. So why am I putting 50 in that over-under account? Well, if last month I created an overlift at 50, then when I settle that overlift, or in this case I'm settling part of that overlift, I can only settle it at 50. So if I create basically a liability at 50, I can only settle that liability at 50. So last month I decreased my over-under account by more than this, 123,600 times 50. Well, I'm making up for 98,040 of that this month. It was created when the price was 50, so it has to come out of the over-under account at 50. If I put it in at 50, it has to come out at 50. So I'm I'm increasing the over-under account, 98,040 barrels at 50 for 4,902,000. The difference is the $2 price difference, right? Again, I'm making up for some of last month's overlift, not all of it, making up for some of last month's overlift when the price was 50. I'm making it up when the price is 52. So I have a receivable from state for 98,040 barrels times 2. Okay. I have a receivable from state asset increase for 196,080. Okay. Now, I still have a negative balance in the imbalance receivable payable, and we'll say a negative balance is considered a liability. Positive balance would be considered a asset or a receivable. So that negative balance is the remaining over delivery from the balance report. 25,560 barrels is still over delivered cumulatively. And that's at $50, which is 1,278,000. So that's what's still in my over-under account. And that will go forward, just like in the sales method where we said it's going to go forward. If it's settled in March when the price is 53, then there'll be a $3 difference paid. Or 54, then there'll be a $4 difference paid. But I always have to leave that over-delivery in at the price it was originally created at, which is 50, until it's made up. Okay. So if we go into state, they've kind of, again, got the opposite thing going on. And state took 300,000 barrels in February and sold those barrels to an outsider. They got $52 from the outsider because that's today's price, or that's what they're going to get. So they have a receivable increased on their balance sheet from that outside purchaser. 300,000 barrels at 52 is 15,600,000 barrels. Their revenue, looking at the last line, is what they were entitled to take this month based on this month's price. They were entitled to take 201,960 barrels based on this month's price of 52. That's their revenue, 10,501,920. So state has the opposite thing going on. They underlifted last month by a whole lot, 123,600 barrels. They're overlifting this month, so they're making up for some of last month's overlift, but not all of it. They're making up for 98,040 barrels of last month's underlift. Okay. At 50, that is a decrease to the over-under account because they're overlifting this month to make up for part of last month's underlift. So that's decreasing the over-under account, 98,040 barrels at 50, 4,902,000. The $2 difference, because the price was 50 last month, it's 52 this month, I now have an account payable to Golden for the amount that was made up for this month. The volume that was made up this month was 98,040 barrels. There's a $2 difference between when this over-under occurred, or last month I actually underlifted. Now I'm overlifting. So when I underlifted it, it was at 50. I'm overlifting some of that back. When it's 52, I've got to pay a $2 price difference. So I've got a liability increased on my balance sheet, an account payable. I have to pay Golden that $2 price difference. So State now has a positive balance of $1,278,000 in their imbalance account. A positive balance is a receivable, or they're still in a net under delivery of 25,560 barrels, which was created in January at a price of 50. So when it's made up, the price difference paid will be the difference between 50 and the price in effect whenever it's made up. Okay, so I know this is a little tough to think about, so go through these a couple of times and let me know what questions you have. The only other thing I'll mention is that you can end up with price layers, and if you do, they come off in a first in, first out order. So let's say one company overlifts 3 months in a row. Now again, we're not going to let them get too significantly out of balance, but I could overlift by just a little bit. I overlift by 600 barrels in January when the price is 50. I overlift by 1,200 barrels in February when the price is 55. And I overlift by 2,000 barrels in March when the price is 60. Well, when I start underlifting, I'm going to take off the oldest prices first. So I'm going to take off the January layer first, then the February layer, then the March layer. I'm always going to pay the difference between the price I'm getting when I'm making up that old overlift. There's going to be a price difference between what the price is now and when that was created. So the January layer is going to come off first. We're not going to actually look at the effects of these, but I think I do want you to know the order in which they come off. So if I'm making up for an old overlift or an old underlift, and I've got more than one layer, because again, if I overlifted 3 months in a row, I might have 3 different layers of prices. I'm going to go to the oldest layer first. That's going to come off first. Then the second oldest layer, then the last layer. So just know that they come off in FIFO order. We're not going to actually look at the accounts on these, but know that they come off in FIFO order. So if I gave you an example and I said, in January I had, let's make up new numbers, 1,000 barrels overlifted at 50 a barrel. In February I had another 1,000 barrels overlifted at 60 a barrel. And in March I had another 1,000 barrels overlifted at 63 a barrel. Well, I would always go back to January 1st. So if I underlifted by 1,500 barrels, if I had $1,000 of overlift in January, I would wipe out that layer first. And then I'd go down to the February layer. So 1,000 barrels would come out of the January layer at the price it was put into in January. Then the next 500 barrels would come out of the February layer at the price that was in effect in February. And I'd have to pay or receive price differences, depending on if I was overlifted or underlifted. But know that the layers come off in FIFO order. So if I asked you, here I'm going to underlift, here's all my old layers of overlift, you'd know that those overlift layers are going to come off in, first out order. I think that's as much depth as we're going to go into. So with that, as always, please ask me if you have questions.